So traders, I'm going to jump straight into this one because first and foremost, it's pretty simple and I don't want to waste too much of your time. Now, this is a very, very powerful concept, and alone it can be a strategy on any time frame of your choice. But we talk about this a lot on this channel, and that is trading with the trend. So if the trend is down, you're looking for sells. If the trend is up, you're looking for buys. Now, there's also a very powerful concept that I use, which is something called the brick wall. You might know it as a trend line. I really don't want to get into the nitty gritty about what the name of it is, but the truth is what we're trying to identify with a trend line or a brick wall is price trading below an area in the market. So just like you have support and resistance, with a trend, you also have an area in the market where price trades below. Now, if you go to your charts now, you pause this video for 30 seconds to a minute, go look at your charts, drop in a brick wall or a level in the market and see how many pairs or charts or timeframes you see where price is trading below the brick wall. Now, the reason why this is very important is because as trend traders, what we're looking to do is we're looking to take advantage of the market's movements when we have clearly identified its directional bias. So now we can see this trend is down. What we want to be doing here is we want to be identifying areas where we can be taking trades. Now, there's 3 areas you can be taking trades in a trending market that will not be incorrect, but have different outcomes in terms of your reward and the potential opportunity to see price turn back against you and you go and draw down for a little bit before the market continues in your direction. But with this illustration, the point is, as long as price is trading below the brick wall, you're good for sells, and vice versa. If it was going up, you'll be good for buys. But in this instance, we're going to use a sell example here, and as you can clearly see, we have lower lows and lower highs. Now, with this structure, the 3 key areas on this market that you will potentially be looking for trades is at the structural high. So this is the pivotal area where you could be taking your trades. The mid zone, which is an area in the market where you may be taking your trade just a little bit early, but still good to take the trade. And then at a later stage, when the market is already moving and you may have not got the best entry, or you may have missed the mid-stage move and now you're entering at a later stage. These are the only 3 areas you'll be looking for trades. Only 3. So with this example, what I want you to understand is this principle. As long as price is trading below the brick wall, whether you enter at the perfect area, at the mid stage, or at a later stage, as long as price is trading below that brick wall, you are still good for sells. Now, I'm going to illustrate this for you on 3 examples: a perfect entry, a mid stage entry, and a late stage entry, and you can see it for yourselves. Let's move on to example number 1. So taking a look at USDJPY in the 15-minute time frame, we can clearly see that the trend of the market is pushing up. Price is making higher lows, higher lows, higher lows, and so on and so forth, and making higher highs. Now we can clearly see that if we look at this structure from a 12-year-old's perspective, we can clearly see prices pushing up. We can also see here that price creates a high, respects the high, and continues to respect the structure here. And that structure is representative of this brick wall where price is trading above. Now remember what I said, as long as price is trading above this brick wall, you're good to buy the market at any stage. But on this occasion, if we plan to buy the market, then this is going to be the pivotal area, the retest of this brick wall, and an area in the market where price is more likely to go up as opposed to have some sort of drawdown or see the market or enter the market too late. So this is our first example, and this is where we're going to be taking our trade, stop loss below structure, and go for a 1-to-2 risk reward ratio. Now, I don't want you to be like, Rox, where do I put the trend line? Do I mark it on the wicks or the bodies and the wicks? Doesn't matter. The point is this: as long as price is above the brick wall, that's all that matters. So it could be here, it could be here, it could be here. It doesn't matter. Make sure you mark it above the brick wall. Now, there's one more thing you need to keep into account, which is the axis level. And that's the level where price has previously created a higher low or a lower high. So as long as you're taking your trade at the brick wall here, and you're placing your stop loss below the brick wall and the axis level, so this level here, where the higher low or lower high forms, stop loss below, you have a very, very high chance of winning this trade, no matter where you enter it. Even if you enter here, 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 here or here, it doesn't matter. Even enter here on the next candle, you still have a very high chance. As long as you don't cheat the markets, you keep your stop loss below the brick wall and the axis level, you'll be completely fine. So this is your perfect entry, the most pivotal area in the market where you could be entering your trades at the brick wall, because as we said, as long as price is trading above the brick wall, then guess what? You should be good for buys no matter where you enter. So that's the perfect example, if you want to call it that. Let's take a look at example number 2. So let's take a look at example number 2 here on pound Aussie dollar on the 1 hour time frame. We can clearly see the structure of this market is making lower lows and lower highs. If we look at this structure from a 12-year-old's perspective, we can clearly see that it is down, and we can clearly see that price is respecting this brick wall here. Now let's say we want to take a trade. We're a bit anxious that the market is creating wick rejections, there's a lot of momentum, and we fear we're going to miss the trade. But we don't have a perfect entry because we don't have the pivotal area in the market. We don't have a retest of this brick wall or any sort of retest of any structure. Is it okay to take this trade while the move is pulling back? Let's say an example like this, pulling back. It's not a late entry, it's not the best entry, it's more of a middle range entry, if you want to call it that. Is it wrong to take the trade? Well, absolutely not. I mean, theoretically, we probably wouldn't take it with a bullish candle, but what did we say the criterias are? The criterias are that price must be trading below the brick wall. And as long as price is trading below the brick wall, then guess what? You're good to go. Mark your axis where the lower high or the higher low is formed. And if you take the trade, just make sure your stop loss is above the key level, the axis, and the brick wall. And then if you plan to take the trade, you should be good to go. In a situation like this, guess what? You may suffer some drawdown because price technically hasn't come back to this key level yet, or this brick wall. And yeah, it might pull back, but the point is price is trading below the brick wall. So are you good to sell it? Absolutely. And let's see what happens. As you can clearly see here, price did start to push for it, which is completely fine, but you have your stop loss in a very safe place above the axis and the brick wall. And now if the market's going to continue trending down, guess what? The market will continue trending down. And as the market continues down, just adjust it and adjust it as long as you need to adjust it for, and as long as it continues selling. So that's more of a mid-range opportunity there, not your perfect entry, not a late entry, but your mid-range entry. The criteria you need to be focusing on is your axis, which is your key level, and your brick wall, and making sure your stop loss is above it. Simple trend trading. Let's take a look at our third and final example. So for our third and final example, we're going to take a look at Bitcoin. Now, the reason why I want to share with you Bitcoin is simply because price action is just all the same, no matter what you're trading. And as long as you're following the trend and sticking to the rules and the concepts and principles that you're learning, it'll work all over the board. So now we're looking at Bitcoin. What can we see? The overall structure is trending up. The markets are making higher highs and higher lows. No one can argue this. We're using the 5-minute time frame, which is an intraday time frame. You can clearly see that the market's respecting the brick wall. Can we take a buy? Well, most would argue no, because we haven't got the perfect entry, and now price has pushed so far already, it means that we're going to have a bigger stop loss, and there's a high chance price can pull back and stop us out. But is that how we should be thinking? Well, no. We're using the brick wall theory here. We're focusing on how a trend moves, and there's only one thing that we really need to be focusing on here. As long as we're respecting structure and identifying where price potentially could come back to in the future before continuing up, we should be good to go. We place our stop loss below the brick wall, which is our trend line, below the axis, and now this is a late entry example here, but it doesn't matter. The point is the trend is up, we're following the trend, we're sticking to our rules, and we're making sure that we're not cheating the markets. It is a late entry, but we're good to go. Price is trading above, the trend is up. Our stop loss is now below the brick wall and also below the axis, which is a key level. Can we take this trade? The answer is yes. Now, as long as price continues to trade above the brick wall and doesn't break below our axis, guess what? We're good to go. As you can clearly see here, we've made it to 5,000 or 58,804, baby. So that's it. A simple concept. Just remember, there is 3 areas in the market that you can look for possible trades when the market is trending. Let's remind you of them. The first area here is going to be the pivotal area, the best area to be entering your trades once a trend has been identified. So it'll be here also, and it'll be here also. But trading doesn't work like that always. Sometimes we get the worst entry, which is completely fine. Here is your mid-range entry where you may anticipate the price will go down. You don't want to wait for price to pull back just in case it doesn't, so you enter a little bit early. But as long as we have our stop loss above, it's completely fine to enter those mid-range entries. Then you have those later entries, which is also completely fine because, again, as long as you're not cheating the market and you're having your stop loss above the brick wall, you'll be completely fine for when price does decide to pull back and then continue down. So I hope you enjoyed that. Very simple concept, but super powerful. And this is a strategy on its own. Super powerful. Nobody has taught it like this before, and I can tell you that fact. There is no such thing as perfection in this market. So whether you get the pivotal entry, the mid-range entry, or the late entry, it doesn't matter. Just pop your stop loss above the brick wall or the key level axis, and you're completely fine. If it's gonna go down, it will go down. If it's gonna go up, it's gonna go up. Anyway, I really hope you enjoyed that video, and if you did, smash that like button for me, subscribe if you haven't, turn on notifications, and as I always say, continue to trust the process.